Hi, everyone. Welcome to Bits and Bips, the interview. I'm your host, Steve Ehrlich, Executive Editor at Unchained. I'm here with a good friend of mine, Chris Giancarlo, former chair of the Commodity Futures Trading Commission. Welcome, Chris.
Steve, being called a good friend by you means a lot to me. Thank you. I feel the same way. It's great to be
Thank
on
you.
with you.
Yeah, I appreciate that. We have a lot to discuss today. I think one of your former employees, Mike Selig, the chief counsel of the SEC's crypto task force, was just nominated to be CFTC chair, had his nomination hearing yesterday. So we're going to break all of that down. But before we do, let's just take a very quick break to hear from the sponsors who make the show possible.
Mantle is pioneering blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. Follow Mantle_official to learn more. Built by the team behind Sui, Walrus is the global data layer for Web3. And with the launch of Seal, developers now get permissioned access controls built right into that data layer. Together, Walrus and Seal make Web3 data private, programmable, and verifiable by default. Learn more at walrus.xyz.
Okay, so I think when Mike was nominated by President Trump a few weeks ago, he was met with universal praise from the community, and I think that wasn't just because we had grown tired of waiting to see if Brian Quintana was actually going to be approved. You know him very well because he used to work for you. I'm wondering if you can maybe share one or two anecdotes that could just sort of illustrate like why the community is so excited to have him as the presumptive CFTC chair.
Yeah. So let me give you a little of the background. So in 2014, I think it was late 2014, my then chief of staff, Jason Goggins, decided we're going to start an intern program in my office for law students. And a number of them came through over the next actually 3 years. Mike was one of the first, and he immediately impressed me with just his native intelligence and his interest in commodity futures, which, it's not like the hottest topic in law school back in a decade ago. And then finally, his just good naturedness. I mean, he just was easy to have around. He was easy to have on the team. And because of that, we brought him into more and more aspects of our work at the commission. And by no means, back in 2014, 2015, was a big part of our docket having to do with crypto. It had to do with all the traditional things that you deal with at the CFTC, from agricultural futures to financial futures to administrative issues to legal issues. And Mike's work was excellent. Anyway, he obviously returned to law school, graduated from law school, and went out and began to practice. And to my delight, his practice was in CFTC matters. Anyway, I carried on at the CFTC. I completed my 5-year term, left in 2019. And in January 2020, I joined the law firm of Wilkie Farr and Gallagher here in New York City, where I am today. And one of the very first calls I made, well, part of my understanding with the firm is I would build a digital practice that we call Wilkie Digital Works. And to build that team, I reached out to Mike Selig, whose work had gone on and grown, and he become more and more focused on digital assets. And I asked him to join me here, which he did in 2022. And everybody else saw what I saw in him, and he quickly worked his way up to become a partner in the firm, which is no easy task in a large international law firm. You've really got to know your stuff, and Mike knew his stuff. So the point I want to, and then in January of this year, Mike was recruited to go and join the crypto task force, then under Hester Peirce. And then eventually he went onto the staff of Chairman Paul Atkins. Now, Paul and I were law school classmates. I've known Paul since the early 80s. And I recommended Mike to Paul and said, you've really got to work with this guy. He's terrific. And a lot of that good work led to his nomination to CFTC. The point your audience needs to understand is, yes, I think the crypto community is excited about Mike, but so is the whole CFTC community. So there were 20 different ag groups that wrote to the ag committee endorsing Mike's nomination of CFTC chair. It's not, crypto bro goes to CFTC. This is somebody who's had a decade-long practice in all aspects of CFTC law and jurisdiction, and is accomplished on all those areas, and who himself, though, is a big believer in digital transformation and has established himself there as well. So his support is really broad-based, not limited to the digital asset community, but is very strong in the digital asset community.
Got it. And actually, I was remiss before. I should have mentioned that aside from just your long history with Mike and your knowledge about the CFTC confirmation process, Mike invited you to introduce him to his hearing yesterday.
It's a remarkable honor, not unprecedented. When I was first, myself in my first confirmation hearing to be a commissioner, Tim Massid was nominated to be chairman, and Senator Blumenthal introduced Tim Massid at that confirmation hearing where I was also being confirmed or having the hearing on my confirmation. So it's not unprecedented. I think it is unprecedented to have a former chairman as opposed to a member of Congress do it. It was a tremendous honor for me, which I began my remarks thanking the committee for the honor. As I noted, I'd been before them many times, but to be before them to introduce a protege of mine for his nomination was a great honor. Should Mike be confirmed, he will be the 16th chairman of the CFTC. I served as the 13th chairman. So it's really remarkable to see someone who served 10 years ago go on to have that honor, and I very much hope he gets it. He's earned it. I hope he gets it.
Yeah, absolutely. So let's get into the hearing. I mean, it touched on, I think it was about 2 hours long or so. It touched on a lot to do with crypto. In fact, the first two questions from Chairman Boozman were related to crypto, which I think is kind of historically important in and of itself.
Yeah.
But
yes.
But I think one of the big issues that kept coming up on a bipartisan basis was whether or not the CFTC has enough resources to oversee spot crypto, prediction markets, and everything else that the CFTC does that has nothing to do with digital assets.
Yeah.
So maybe let's just talk about that first.
Okay.
What is your sense? The SEC has 5,000 employees. CFTC has about 600. Crypto is, depending on given day, $2-3 trillion, $4 trillion market. And then there's the rest of commodities. Right. Does the CFTC have the resources?
Right. So look, Mike was very clear. He said, look, I don't get to apportion resources. You do. Congress does. I don't. He was pressed by senators saying, yes, but would you use your influence on the president to get these appropriations done, or to press Congress to get these appropriations done? And Mike rightfully said, look, I'm a lowly appointee. I don't get to tell the president or Congress what to do. And I can relate to that. I mean, when I was in that chair, I had to take the same position. I mean, the Congress and the White House have only so much resources to allocate. And the last thing you want is every head of every agency going back and demanding their portion of it, on a public record. Now, I, as a former chairman and no longer in government, have been very vocal and remain so that I believe the CFTC has to have more resources to allocate to this. And I believe that the drafts of the Clarity Act that are circulating will give the CFTC as much as $150 million more resources. But it's not from Mike to say, and his job is to get confirmed, and then he'll be in a better position. His position was, I need to see the budget. I need to better understand it. As a former chairman, I'm happy to say that they need more resources. Now, one other thing that I'll say that's a little bit more controversial, I think those resources should come from industry. If I want to take my company public and I go to the SEC and file a registration statement, I've got to pay for the review of that registration statement. There's a fee. And that's not too different than what every one of your viewer does in their own life. If you want to put an addition on your kitchen and you submit plans to the town's going to tell you to pay the fee of the examiner, of the building inspector, to do that, right? And that's only fair.
Because getting a car inspected, you have to pay.
Well, exactly. Why should your neighbors, why should the taxpayers pay for you to do that? You should pay for it. And I feel the industry should pay for the registration of tokens on a spot exchange at the CFTC. Now, that's controversial. In the futures markets, registrants do not pay the fees. It's paid basically by the taxpayer. And I'll leave that one alone. That's been around for a long, long time. But in a new industry like crypto, I think it's only fair. And as an advocate for this industry, I think it actually makes the industry stronger. That we're looking after our, we're paying our own way, and I think that makes this more palatable to the taxpayers out there that couldn't give a whit about crypto. They just want to make sure that they're not paying too much in taxes. So I think it's only fair, but I don't think you're going to hear that from Mike Selig anytime soon. His job is to get confirmed and get into the chairman's role and start running the agency.
Yeah, it seems like it might align with like the principles first approach to regulation that the CFTC has as well.
Absolutely.
Okay, so let's get into it. Overhanging all of this is the market structure bill, and I don't necessarily want to talk with you about that today because we have limited time, and I want to really focus on things that are that you're uniquely qualified to talk about because of your history at the CFTC. You and I have spoken many times about spot commodities markets and how they're very different than securities. There are information asymmetries built in. That's just how these things work. They're often decentralized. They're done like OTC block trades, but now we have these large exchanges that are sort of like that are acting like more traditional exchanges, but they're going to oversee spot commodity. What are the challenges that he's going to face in overseeing this type of market?
Yeah, so it's a very good point. And so for your audience understands, historically, most commodity futures, which is what the CFTC regulates, derivatives on commodities. In other words, what is going to be the buying or selling the future price of wheat or corn or oil. Most of those commodities came out of the ground, and most of the spot sales, meaning I'll sell it to you immediately in return for cash immediately, were regulated at the state level, not at the federal level. And that's because those transactions take place inside of a state. A farmer sells his wheat to the grain elevator in the next town over. That takes place in that state. It's not a federal transaction. But when these futures markets developed, they developed in major cities like Chicago, Kansas City, and New York, and they became national markets. And so the CFTC was formed to regulate these national markets in derivatives, in futures and forwards and options that traded on these national exchanges. And so you have this anomaly that the spot market is not regulated at the federal level, it's regulated at the state level, but the derivative markets are regulated at the national level. Along comes crypto. And in crypto, you have both spot markets. I want to buy 5 Bitcoin now, or you have derivative markets. I want to buy Bitcoin futures to basically take a view as to where the price will be 6 months from now. Right now, if it takes place if you're buying or selling something takes place 6 months from now, that's federally regulated by the CFTC. But if you do a spot transaction, it's not regulated at the national level. And yet, unlike ag markets, those spot markets are national if they're not indeed international. And so the argument is that when it comes to crypto, unlike ag futures, the regulation of the spot market should be done at the national level, which means the CFTC. That is actually one of the big areas of this new bill, what we call the Market Structure or Clarity Act, where there's bipartisan agreement. I spoke to many Democrat senators yesterday, Republican senators. It seems to be that's one issue that's pretty much resolved, that the CFTC is going to get, for the first time, authority over spot trading in derivatives. And I think that's a big thing. And that goes to your question, Steve, as to what's the big challenge for Mike. Now, Mike will now need to develop a regulatory regime for the spot. What do we mean by the regulatory regime? We mean, how do exchanges operate? What are their capital requirements? What are their operating requirements? What are their customer protection issues? How are their margin models set and monitored? What inspections does the CFTC do?
Or how do they even register?
How do you register? All of those will need to be put in place. Now, the good news is they're already in place for the derivative exchanges. And I'm quite certain, it's because it's just logical, the CFTC is going to borrow from a lot of that regulatory structure to regulate spot markets. So I think it will be a load of work, but I don't think it's going to be an intellectual challenge for the CFTC because they have very good working models. Let's remember one thing. No CFTC exchange failed during the great financial crisis. The CFTC's model has been around for over 40 years. The agency's been around for over 40 years, and its structures and its models have been very, very durable through one crisis after another. So I think it lends itself to putting a new structure, to using that as the basis for the structure for this new landscape.
Just a quick follow up to that, and then I want to move to prediction markets. But
Yep.
a lot of like FCMs, DCMs, I mean, they're not these vertically integrated behemoths that
Right.
spot exchanges are in crypto today. How does I appreciate your point, but I know that Mike was also asked yesterday if these exchanges should stay vertically integrated, custody, clearance, settlement, execution, all of it. Do you think that is
Yeah.
something
So
that
there's philosophical differences, philosophical underpinnings to one's view. I'm one of those who believe that market structure should not be dictated for the convenience of regulators, but for the convenience of consumers, right? It should be built around what does the market want, not what do the regulators want. And then the regulators need to apply their principles of customer protection, but the structure should be organic to the industry. The crypto industry, unlike say the ag industry, has grown up with an integrated model. And I think it would be wrong. This is Chris Giancarlo's view. I don't want to put words in Mike Selig's mouth. Chris Giancarlo's view is I think it would be wrong for regulators to say, no, 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 no. We don't care what you've done. You've got to do it the way we like it. And here's our market structure. I think that's just wrong. I think it's not American. I think our approach should be, okay, we accept that's the way you've evolved this market. Now, how do we work into that customer protection? How do we work into that the protection of customer accounts, which the CFTC has been brilliant at? Because I think, as your audience know, the one piece of the Sam Bankman FTX empire that didn't fail was the piece under CFTC supervision, because the CFTC requires what we call segregation or protection of customer accounts. So I think the CFTC, my view is the CFTC should come at this and say, okay, we accept the way the marketplace has evolved its market structure, but now we need to overlay that these principles of customer and market protection that have served us so well decade after decade. So let's approach it from a customer account segregation, from a investor protection, investor education, et cetera, et cetera.
got it. DeFi was also a big topic. I believe it was actually Chairman Boozman's second question. Democrat DeFi plans sort of threw a wrench in market structure a few weeks back, and with a lot of these commodities trading on DeFi platforms, there are questions about how to sort of balance the oversight versus innovation, that debate that's been going on for millennia. So how do you see, Mike?
So I had a great day in Washington yesterday. Not only did I have the honor to introduce Mike to the committee, but I actually met with about a little over half a dozen key senators on this, from the banking committee to the ag committee. And I came away from that believing that the big issue in passage of the Clarity Act is the DeFi piece. I think almost all the other issues have been addressed and resolved, and I think that's the one big piece. Now, what does the DeFi piece mean? It is what regulation should be applicable to participants in the decentralized finance world, software developers, layer one developers, et cetera. And there is a difference there. The Democrats are rightfully focused on law enforcement, and how do we be able to provide, provisions against money laundering and all the bad things of illicit finance. I think their motives are good. I think they're going about it the wrong way. Their approach would be to impose upon developers in the DeFi sphere all the panoply of Bank Secrecy Act requirements for anti-loan, and basically they're responsible for gathering financial information from participants. And I'm one of those who believe the Bank Secrecy Act is long overdue for a full revision. It's all focused on identity rather than activity. And I think the better approach of law enforcement should be we focus on activity by allowing law enforcement to be nodes on blockchains, but allowing people to otherwise operate anonymously. Republicans that I spoke to believe that we really, don't want to impose Bank Secrecy Act obligations on DeFi until we know what problem we're trying to solve. What is the public policy we're trying to achieve? And so I think there's a lot of efforts underway right now. The good news is there's a lot of conversations going on. Anybody that was in the room yesterday saw a lot of conversations between Cory Booker, who's become the point person on the Ag Committee, Democrat side, to negotiate the Clarity Act. A lot of conversations going on with Chairman Boozman. over this, and other senators I spoke to referred to the high level of conversations. At the end of the day, the politicians are anticipating that crypto is going to be as active in the next November's elections as they were a year ago, and they've got to deliver. I think both sides of the aisle, despite their differences on many things, really feel the pressure to deliver on crypto. And so I think there is a good faith effort on both sides of the aisle to come together. And I think they've actually addressed most of the issues in the Clarity Act, with the exception of DeFi. I think DeFi is the hard one. But there's a lot of efforts to try to get that. As I say, I think there's some philosophical differences to what do we do about DeFi and whether it's even ripe for addressing, or whether it's even the right area to go about tackling illicit finance. But that will remain to be seen. That's going to be a hard one, but I think with the effort that's underway, it is doable, and I'm cautiously optimistic a bill may get done in the first quarter of next year.
Got it. Okay. Two more questions, and then we'll wrap up. One, this did not come up in the hearing, but I'm just interested if you have any sense of Mike's thoughts on perps, especially now that they're really coming onshore here in the U.S. With the potential for explosive growth.
I don't know Mike's views on this, and even if I had an inkling, it would be inappropriate for me to put my try to speak for him.
Fair enough. Then, as a former CFTC chair,
of course. What I would say about perps is that the CFTC has a pretty, well ingrained set of rules. The fact of the matter is, perps are not illegal under CFTC law. They just need to trade on a fully licensed exchange, what in CFTC parlance is called a designated contract market, or a DCM. And the CFTC and the self-regulator, which may be that DCM, it may be the National Futures Association, have a role to play in setting the margin model. And so it's not like there's new law that needs to be created for perps in the United States. The law is actually in place. It's full registration as a full exchange, a CFTC exchange, with margin models that have to be approved, reviewed by the agency, and of course clearing services through a recognized licensed clearinghouse. So I don't think perps are a foreign idea or a foreign concept or impermissible. The regulatory burden is high. So any chairman, whether it's Mike Selig or others, doesn't walk in and say, oh, I want to do this with regard to perps. They walk in and say the law is pretty much already baked. Here are the rules, follow the rules, and we can get this done. We can get going.
Got it. So let's take one more quick break to hear from another one of our sponsors, and then we'll wrap up.
Mantle leads the establishment of blockchain for banking as the next frontier. UR is the access layer that transforms Mantle Network into a purpose-built vertical platform, the blockchain for banking, that enables financial services on-chain. UR unifies and vertically aligns Mantle's focus on payments, trading, and assets. MI4, METH protocol, functions FBTC, supported by developer grants, ecosystem incentives, and the industry-leading distribution platform through the UR app, Reward Station, and Bybit launch pool. All economic activity within UR will be captured by Mantle Network to further drive value to token holders and establish its significance in blockchain for banking. Follow Mantle_official to learn more. Meet Walrus, Web3's data layer, solving on-chain privacy with Seal. Think of Walrus as the vault and Seal as the key. Together, they give developers fast, composable access to data with encryption and permissions baked in. That means new possibilities like token-gated datasets, AI marketplaces with enforceable access rules, game logic that only reveals when it should, even DAO governance flows where data stays private until the right moment. From AI to DeFi, Walrus and Seal make the data layer more powerful, practical, and secure. And yes, we use them too. Go to walrus.xyz to learn why Web3's leading teams are building on Seal plus Walrus.
Okay, so we're back with Chris Giancarlo. Last question. We didn't get a chance to touch on prediction markets yet, but that was another big focus of discussion, in particular, whether or not like CFTC laws preempt state laws, particularly when it comes to sports betting or or gambling. I'm just want to know if you have any quick thoughts on that, and then I'd love to just get your very brief outlook on what might happen next. It looks like the candidacy might move out of committee today and move to a full vote in the Senate, perhaps as early as next week. So
yeah, I'll answer the last question first. I think it's looking. I know Mike Selig's confirmation is a priority for the White House. They've communicated that to House and Senate leadership. So I think Mike there'll be a vote on him out of committee, I think, in the next 24 hours. And I look to him to actually have a floor vote before Christmas. And I think Mike could be in the seat and get rolling before the year end. On prediction markets, I'm a huge fan. As you know, I've been an advisor to Shane Copeland and Polymarket. I believe prediction markets are a huge initial application of digital assets and stable coins that are going to have a lasting impact. I often ask audiences who check the weather report before leaving the house today, and it's always the same. It's about 4/5 of the people in the audience raise their hands, and I say, look, it's going to be 90%, 10% wrong and 90% right, but it gives you predictability. You're going to put on a raincoat if it says rain, and that's important. Humans like predictability, and yet in a world of so many variables, there's very little predictability. Will the shutdown last another week so that I maybe put off that trip to Chicago because I may not get there on my flight? Will there be one or two Fed rate decreases so that I think about remortgaging my home? Who will win that next election because I've got energy stocks, maybe I want to sell out of them depending on who wins the next election? Or do I want to move out of New York City if there's going to be a different set of policies under a new mayor? People like predictability, and polls don't give you predictability. They give you biases, and that's why they have these margins of error. Now, I'm not ragging on polling. I know it's a science that's been refined over the years, but it lacks incentives. What makes prediction markets so accurate, and how accurate? In 2024, when more humans went to the polls than ever before in human history, it was accurate in every poll in the world. From France to Japan to Britain, everywhere else, including the United States. People like predictability, and they like actually saying, I have concern about this. What do others think? Which is what prediction markets do. And so I think prediction markets are a tremendous application. I think their time has come. Now, what does that mean? Well, a lot like Uber, which came up with an application for the internet, a great application in terms of ride sharing. It ran into a regulatory maze that was put together under the analog world of taxi and limousine commissions in cities and states, every one of them having different structures and different monopolies. And it had to break through that almost item by item. I think the path for prediction markets is in much the same way. You've got state gambling laws, you got casinos, you got others, all of which have vested interest in the status quo. And I think this is going to take time. So I think Mike was quite right. The courts have a role to play in this. Congress has a role to play in this. And for now, the landscape is less than crystal clear. Nobody can say definitively what is the role of states and federal. My personal view, again, this is not Mike Selig, this is Chris Giancarlo, is that what will emerge from this will be in the narrower set of local gambling interests. There'll be a role for state regulation. In the much broader set of prediction markets on elections, on interest rates, on corporate earnings, on things like that, that has to be done at the federal level. And I think you'll see some shared responsibility. As, by the way, we do that in our banking system right now. You got bank regulators and federal regulators. We do that in the securities world. You want to offer securities to New York residents, you got to go through both the Securities Exchange Commission and New York Department of Financial Services. So I think you're going to have some shared responsibility where the state has a legitimate local interest in gambling parlors and track racing, but in the broader area of events contracts. Beyond that, I think you're going to see an exclusive federal jurisdiction. But I think that's going to take years to evolve in the same way that Uber took years to. What will make it, though, go is that this innovation is something that people want. I think people love prediction markets, and I think that's only going to grow, especially with a younger generation coming, into prominence. I think prediction markets are one of the huge new business models of the future.
Yeah, absolutely. Well, Chris, thank you so much for the time and sharing your reflections on what happened yesterday in DC. Thanks to everybody watching and listening. Stay tuned. I'm going to be back with another interview with Markus Thielen, head of research at 10X Research. Thank you again, Chris.
Great to see you, Steve. Bye, everybody.
Hi, everyone. Welcome back. Once again, I'm Steve Ehrlich, executive editor here at Unchained and host of Bits and Bips, the interview. Let's take a quick break to hear from the ads who make this show possible.
Are you a builder who needs to add on-chain trading to your product? The Uniswap Trading API from Uniswap Labs offers plug-and-play access to some of the deepest liquidity in crypto. It's on-chain execution at an enterprise level. More liquidity, less complexity. Visit hub.uniswap.org to learn more.
So I'm here now with Markus Thielen, the head of research at research firm 10x Research, a firm that produces daily intelligence and market briefings on everything happening in crypto. And we're here to talk about what's happened in the market, especially in light of NVIDIA earnings, how to trade tactically during bearish times, and also when it's appropriate to call a bear market, and in light of crypto's heightened volatility. So welcome, Markus.
Yeah, thanks for having me. Excited to be here.
Yeah. So let's just kind of dive right into it. Everybody was waiting with bated breath on NVIDIA's earnings yesterday, wondering if they could outperform again and perhaps lift the entire economy, the entire market out of this sluggish pattern. They did very well. What did you see, and how did crypto respond?
Yeah, I think this is probably a temporary rebound that we're having right here for crypto, especially for Bitcoin. Of course, we still have the macro overhangs of a hawkish Fed. We still have the on-chain data that indicates that there's a lot of outflows. Of course, the ETFs are very overexposed right now. We can, of course, go in detail, about those kind of flows, because those were the ones that were really pushing the market lower over the last couple of days or the last 2-3 weeks, really. And I don't think it's going to stop because, people need to clean up their books into year end. But nevertheless, we're coming into actually a period where the RSI is very oversold, where the sentiment indicator is really negative right now. So it's hardly to go negative here because we are already so low. And I think from a technical perspective, we can have some rebound, but the question really is, how long is this going to last? And we suspect this is going to be a couple of days, maybe a week or two. But I think then the market is going to worry again about the Fed, and the Fed has indicated there might not be hiking. And I think we have seen the repricing already, of course, from 70% probability to just 30%. So it's unlikely it's going to go much lower, but it's not going to give a lot of tailwind for crypto here. And I think that's why we're coming into the year end, flows clean up their books for institutional investors. And I think that's going to remain an overhang until really year end.
Okay. So let's kind of break some of that down step by step. First, I'd love for you to kind of define a bear market, especially in terms of crypto. I know in TradFi, usually a 20% drop from a local high is sort of the marker. But given, again, Bitcoin and crypto's volatility, that seems to be way too shallow. So how do you define it?
So, of course, I think with crypto, we have to be realistic. The market does not go up all the time. The market swings up and down. And I think the market reacts a lot to macroeconomic indicators. But, to really define what is a bear market, when Bitcoin is in a bear market, I think there's clearly defined on-chain indicators, the MBRV, for example, that we look at. But also there are certain moving averages that indicate when Bitcoin is in a bear market. Can it be, for example, the 12 months moving average, so something like a 50-week moving average, or we prefer actually the shorter period, which is the 21-week moving average. And we back tested this every time when Bitcoin is below this level. It is sort of like the stop level where we want to stop out of long positions. And, we came into this period, for example, earlier in the year where Bitcoin broke the 21-week moving average. So if you would have followed this rule, you would have been out of the market, while Trump was really ramping up, the tariff talk. And very similar to last year. Last year, also during the summer, you would have been out of the market. Yes, we're bouncing sometimes up and down to this level. But nevertheless, it is kind of like a rule of thumb, is a little bit more, technical in the sense. It's not just like a 20% drawdown and then we're in a bear market. Because historically, that's usually when we get some Fed reaction function. But of course, that's when the Fed was more forward-looking versus now the Fed is backward-looking. But again, we have, come up with a whole rule book of on-chain indicators when really the market is in a bear market. And based on those indicators, Bitcoin is clearly in a bear market since actually late last month, really, when a lot of those indicators turned down. And I think an easier indicator that we really like is really the short-term realized price. So which is basically the average price of everybody who bought Bitcoin the last 155 days. And when Bitcoin is below this level, we start to see people being liquidated because, hey, I'm suddenly underwater. I want to, protect my capital, and they're going to get stopped out. And then those people that are underwater did not get stopped out. They are praying, of course, that the market goes back to this average price. And once the market, attempts to rally above this level, usually we see another wave of liquidations because finally those people, thank God we rallied back to this level. Let me get out of my break-even price. And that's where we really struggle to really go above this line. And we came into this like last year, for example, where the market struggled. We came into this early this year. And again, we are now there as well. And I think that's why sort of like the market struggles here a little bit. But of course, it's a lot of the year-end flow that we're seeing, a little of the unwinding of the ETFs. But, happy to talk about those, of course, in detail as well.
Yeah, so we'll get into that. But I want to just stick on the topic of like comparing this bear market, which you say we've been in for a little while now, with some of the others. You talked earlier this year. I mean, that had to have been around the Trump Liberation Day tariffs that spooked everybody. And then another, I guess, analogy I've been hearing is going back to 2022. And I know Bitcoin hasn't dropped down to like those levels yet, but at least like in 2022, and then again with the Liberation Day tariffs, like there was a clear sort of like driver for this, a clear end for like when the market was going to reverse itself in 2022. It's like when FTX happened, that kind of flushed out the rest of the liquidity. In earlier this spring, Trump reversed some of his tariffs or paused them, delayed them, the whole taco trade everybody was talking about, and that sort of let everyone have time to breathe. This bear market we're in right now, it's hard to see where the bottom is. I mean, there's some bearish factors, as you mentioned. I mean, low expectations for another Fed cut. We had the China tariffs and the massive liquidations on October 10th that sort of drew out a lot of liquidity that I don't believe has returned. And people are kind of really wondering what's next. Is tech still too overpriced? So how do traders approach this particular market when they're not quite sure when the bottom sets in? As you know, nobody wants to catch a falling knife.
Yeah, so the key difference is that for the first time really in 3 years, Bitcoin broke the 50-week moving average. And I think that's sort of like one of the rule of thumbs, how a lot of, institutional investors, long-term investors really, base their decisions upon. And, we didn't break it earlier this year. We didn't break it last year. People were sitting on healthy profits. But of course, right now, people are not sitting on so healthy profits anymore. And I think the key difference is also that, a year ago, when Trump was elected, Bitcoin was trading around 67,000. And we very quickly rallied up 20,000 points or a little bit more within basically a 2-week frame. So there was not a lot of trading between 67,000 to 93,000. So there's like a window here where there is not a lot of support. It's almost like a void really. And I think that's really like the difficulty when we look back the last couple of months. We had a trading range of 90 to 100 and then 100 to kind of like 116 for many weeks really. And of course the market has really set its technical levels there, but this time we are really at a period where there is not a lot of support. As you correctly said, where is really the low here? There is some more liquidity, let's say at 84,000, and I think 84,000 is also like a level where a lot of people suddenly sit really underwater. I think the market right now as a whole is still up around like 20%, but it's actually not that much, right? When you look at, where Bitcoin really came from. So that the true short-term mean of really everybody who bought the last couple of years sits at 83,000. And of course, if we go below it, then of course, a lot of people are going to be underwater. And then I think the next level is probably the 73,000. And then as you probably remember, that was really the kind of like the ceiling where we saw last year. And that really stayed really between March of 2024 to really just before the Trump election. And we bounced around, we dropped to 50K, we came back up, but we didn't manage to go above it. So it really seems that this bull market is very different than all the other bull markets because we seem to, trade in a kind of like stop and go environment. There's a big catalyst We rally up, in a very short period of time, in a week or two, but then we go sideways for a couple of months, and a lot of stuff seems to happen, but nothing really seems to push prices up. And of course, as you also pointed out, October 10th was suddenly a really, important event, because just like, 2-3 days before, Bitcoin was making new all-time highs. Really, we were at 126, but it was also sort of like a dangerous level at the same time, because every time when Bitcoin makes a new all-time high, but doesn't really accelerate and goes back to this level, it actually seems to be a level where it does collapse. So what we want is, we want to make a new all-time high on high volume, and then a parabolic move. So we want to distance ourselves. And, you might also remember, like last year, when Bitcoin made the new all-time high in March, and I think it was around like 67,000, 68,000. We went up to a little bit above 70,000, but we failed to accelerate. So there was suddenly not a lot of, money coming into the market. Quite the contrary. Of course, a lot of the OGs, a lot of the long-term holders were suddenly liquidating. Probably a lot of people who got into the highs of the previous bull market were really happy to see those levels again, and then really liquidate and really keep a seeding on the market. And I think that's very similar, where, we started to make a new high, but then we didn't really accelerate. And I think the biggest example is probably in 2021, when we made a new all-time high in April, and then we sold off in May. And that was, of course, the end sort of like of the DeFi narrative. But then we started to make new all-time highs in October, November, based on the whole NFT story and NFT minting. But then, of course, a new all-time high, but the market didn't accelerate, and then we quickly collapsed. And I think that's sort of like the worry here as well. But of course, the issue, I think, is a little bit, I think there's a lot of stories to tell. And I don't think the last chapter has been written about this October 10th crash, because so many people were stopped out. But I think what's most important, we wrote about it, and hardly anybody wrote about it, I assume. But the liquidations on Binance were only 59% longs. And I think that's kind of like puzzling, because the market went down, 20%. A lot of altcoins went down 30, 40, 50%. But how come only 59% of the people that were stopped out were longs, right? So instead of shorts, right? So a lot of shorts were stopped out, and I think there's a mismatch between people's trading books that were basically market neutral. They were suddenly stopped out at levels where they couldn't really reconcile the trades.
Yeah, I remember that. I like, just like anecdotally, because there were lots of people that had profitable short trades that were stopped out, and they were upset, and obviously they were upset, and some felt that they were perhaps even mistreated by some of the exchanges because of what happened. We need to take a break soon, but I want to just ask you, before we do, what are some of the tactical ways that people might be able to trade in this type of bearish climate? You talked about how there could be some brief relief rallies from time to time. Maybe we might even be in one right now in light of the NVIDIA earnings. So what are some of the things that people can try to do, and like what's like one or two signals to look for to know when like these perhaps like brief respites might be over?
Yeah, of course, there's, the technical side. There's, of course, the RSIs, the stochastics, every time they're really oversold levels, there's a chance that we're going to rebound. There's, of course, a lot of sentiment indicators. But of course, there's, I think, two kind of very interesting ones. There's, of course, the Coinbase Bitcoin premium or discount. And, since actually end of last month, there's the premium has actually evaporated and went into a discount, which, we can argue that a lot of institutional investors, a lot of US investors really trade, on Coinbase relative, let's say, on the global exchanges relative to Binance. And of course, every time this is in a discount, it probably indicates that more US flows are selling off. So that's kind of like a level where, we have been seeing the discount actually quite steep, but the discount sort of started to narrow a little bit. So maybe there's less outflows. And I think we saw this, on Tuesday. Basically, there's a lot, there was actually some net buying despite the market started to go down. So maybe some US investors started to pick a bottom here a little bit. The RSI actually started to turn around a bit. So there is some positive divergence happening. But also something that we noticed was that the skew, so the price or the implied volatility that is used for puts versus calls, which of course was in heavy favor over the last, 5 weeks, really, for in favor of puts, really, to a lot of people who were buying puts relative to calls, but that started to actually shift a little bit. So it's still negative, but it's not as negative as it was on Monday morning. So there were some factors that looked actually that on the margin, the market is starting to trade a little bit more positively. And of course, maybe with the NVIDIA, story now, NVIDIA earnings, so the market maybe looks a little bit more on the positive side because the AI spending boom doesn't seem to be over. And that's kind of like the factors that we look at, just a couple of, top of my head, that is more market timing perspective, because very often in these bear markets, we see rallies of like 10% very quickly. And I think we can capture those rallies up until, of course, the price goes back to some resistance level. And I think the resistance level is around 100,000. So it will be very, very difficult to go above 100,000, but it still can be a rally, that we can catch here.
So I want to touch on a few other topics in the news. First, you were a little more bullish on ETH than even Bitcoin in one of your most recent reports. Can you just explain what you saw?
So for Ethereum, we were actually, more bearish. That's actually something that we recommended as a hedge, as a, underperformance against Bitcoin end of last month. So we actually we predicted that Ethereum should drop from 3,800 to 2,700, 2,800, because we are still in this negative environment. We were pointing out that, based on some transaction volumes from activity, on-chain activity, that there might be a value level, and we define this value level, below 3,300. It doesn't mean that people should buy, Ethereum immediately if it goes below this level. But if we look into next year, where, for example, we probably have a new Fed chair, we probably have a more dovish environment. So, and of course, maybe a lot more stuff is going to happen on, the DeFi space. If they, the market structure report is going to come out. So I think there's a lot of stuff brewing in the background. It doesn't mean we want to, buy it today, but we want to define where there is value. And the value is not when it's at 4,000. The value is not really coming from the stablecoin market. The value is only really going to come if there's more transactions on DeFi. And DeFi might be a bigger theme next year with the, with the market structure bill. But of course, we don't have this yet. But we just wanted to point people, towards, where is really the level to buy, if sort of like the market turns around, whether it's really, more value approaching. Because I think, defining value in crypto has always been quite difficult the last couple of years. I feel like it was a lot easier in the last bull market because there was a lot more revenue. Of course, Ethereum, they switched the revenue mechanics, and there's a lot less revenue going around these days. But last cycle, we could really define it. Certain NFT minting generated X amount of revenue, and that usually associated with a price of Y. But this cycle, it's a lot, there's not a lot of revenue because a lot of people are not really using DeFi. The action is somewhere else.
Yeah. Okay. Are there any other tokens that really stand out to you, or privacy coins or alts, that have really interesting charts, or sort of like any like overlooked gems that investors might want to pay attention to?
I think that's a very tough one in this environment, simply from the fact if for example, Bitcoin dominance, grinds up a little bit, as I think it's going right now a little bit higher, while the market cap goes down, it's sort of like the period where actually you don't want to be exposed to anything. And I think it's a little bit surprising, because normally in these like sell-off periods, we see, of course, the Bitcoin dominance actually rising more sharply because people selling altcoins and putting the money back into Bitcoin. But I think what we're seeing really the last 1 or 2 weeks is actually people are off ramping. So we saw, of course, that USDC had some redemptions. So that's, I think, a sign that people actually are not going from altcoins to Bitcoin. They're going from altcoins to USDC to probably off ramping. It's small. It's just a couple of $100 million. But it's almost like people don't want to, keep a lot of money right now in the crypto space, because also a lot of the altcoins, they're seeing around like $59 billion US of unlocks per year currently. So there's a lot of overhang, and I think a lot of the VCs from the previous bull markets basically have to really liquidate some tokens because their LPs want the money finally back and maybe want to go all into AI. So I think there's a lot of headwinds for some tokens. Of course, there is momentum, and we are momentum traders in crypto. So if something is breaking out, we are sort of like jumping on it. But all these favorite of this cycle, the Athenas of the world, they're not really great investments here unless really there's a lot more money coming into the space. And it really seems, as long as the Fed is hawkish, not a lot of money is going to come in. So I think that's why, staying on the sidelines is probably, the right approach. And we don't have to trade all the time.
Yeah, I guess moving money out of crypto to stable is off chain is the ultimate form of capitulation. So that is something interesting to follow. All right, so let's talk about DATs and ETFs, because I know this is a topic that you also watch closely. It's no secret to anyone watching or listening that DATs have been struggling. MNAVs have been dropping. Even strategy dropped below 1 briefly, although I don't know where it is exactly at this moment. But times are really tough, and I'm wondering if you could kind of give me your assessment there. But also, I know that you look at the interplay between ETF flows, which are net negative for a little while now, and how that also negatively impacts, I guess, the ability of DATs to try to begin to raise accretively again.
Yeah, so I think the very interesting aspect, is really, I think there are two really notable points. I feel like, last year in February, end of February, when the market really started to ramp up after the introduction of the ETFs, suddenly MicroStrategy's NAV was expanding, significantly, really from, a little bit above 1, I think 1.2 to kind of like 1.5 and then it's 2 and then higher. And people were really puzzled by this because people expected here's an ETF that trades at an NAV of, 1. So why would somebody pay a lot of premium? And of course, people argue that maybe there are some restrictions where people cannot buy ETFs, but they can only buy these companies really. But we have a slightly different theory. And the theory is really that once Bitcoin went above $45,000 per Bitcoin, which is literally, the average price of a car in the US, which is the average first year salary, people actually thought, Bitcoin is actually quite expensive and, I cannot really afford the whole Bitcoin. And I think there's some psychology, going on here where people sort of like just bought sort of like the cheaper alternative. But of course, the whole DAT trade, they don't really use a lot of free cash flow to buy additional shares. They use basically, the NAV premium. And when we came into the summer this year, we're expecting that actually the volatility would decline a lot. And with a decline in volatility, the right tail probability of higher returns were actually also diminished. And I think that really, coincided with the NAVs really being compressed. And of course, there was not really a lot of ability to raise more capital. So not a lot more capital were coming into the space. And I think that's where sort of the steam ran out really for the DATs, because there's no really real story about generating some additional yields. I think they have, of course, a big balance sheet now, especially MicroStrategy. And I think they should become more like hedge funds in the sense that they're selling, upside calls, because you can generate 15 to 20% yield with, these overwriting strategies. And I think there's some other, tools in the box really that they can, bring out, but it's no longer, waiting for a retail euphoria and then selling high shares, telling a great, story, because I think retail, has been, burned a lot. So we calculated that MicroStrategy raised around, $45 billion since August 2020, and around 20 billion was really raised with an NAV above 1. So basically, retail investors who ever bought, paid a premium of $20 billion in total. And as you correctly said, the NAV is basically back to, around 1. So basically, $20 billion has been literally evaporated, into nothing really. And I think that's kind of like a loss that a lot of people probably question if this is the right strategy for them to invest again. And I think we saw something similar in Japan with MetaPlanet, where, people were buying the shares at an implied Bitcoin price of 800,000 USD. And of course, now we are sort of like materially lower because the NAV is also, below 1. So basically, a lot of money has been lost there too. And I think that's why it's very difficult to restart this narrative. But I think it brings also like very interesting concept because, that Ethereum had around, $10 billion of inflows year to date and for the Ethereum ETF. But they were only really in July and in August, and there wasn't really any material inflow before. There wasn't any material inflow after. But we're seeing, of course, this month a lot of outflows for the Ethereum ETF. And I think it's really the question now that because the futures traders, especially the perpetual futures traders, almost like the crypto native people, they were literally all stopped out, on October 10th. So basically, Bitcoin is down year to date. Ethereum is down more than 10% year to date. The futures traders are basically sort of like, neutral relative. If you compare really the change in open interest where we are currently versus where we were on January 1st. So basically, nobody is long except really a lot of the ETFs. And the ETFs, the Bitcoin ETFs, they have net bought, around like 23, 24 billion year to date versus the Bitcoin price is down year to date. So it's definitely some over allocation. And it's not that the 13F filings really make a lot of, the Harvard endowment funds or some of the institutional investors really look good here if they have increased their exposure, because they're looking actually not so great now because the price has gone down. And very similar with Ethereum, because Ethereum, a lot smaller market cap, but here the ETFs are net long $10 billion year to date, versus Ethereum is actually down 10%. So that's why we were arguing over the last 2-3 weeks that we're probably going to see more outflows from the ETFs because people need to be, adjusting their books. And if you are a multi-strategy investor, you're having some stocks, you're having some commodities, you're having some crypto, and then you're sending out your statement to your investors, and they look at you and say, it's like, oh, you're long, $1 billion in Ethereum ETFs, but Ethereum is down 10%. It wasn't a great move. Why didn't you buy more QQQs? Why didn't you buy more NASDAQ? And I think that's sort of like the story that institutional investors want to get ahead, and that's why they're probably liquidating some of their portfolios, and that's why we're seeing this sort of like selling pressure now in the market.
Okay. Just quickly, last couple things. One, with the rise of staking ETFs, how does that impact the debt calculus? I would imagine it like makes their theoretical hurdle rate now much higher, and I know you also pointed out some hidden costs that may not be apparent to investors that actually lower the yield or premium that people might get from buying some of these debts. Can you just walk us through that quickly?
Yeah, I think when we go back to the last bull market, which was of course, extremely exciting because, retail investors were basically getting, 4 to 6% yield on their, crypto holdings. And of course, the BlockFis of the world, they were generating 8% yield, and they were generating this yield really through, lending to Three Arrows Capital or through Alameda, research really, who really took, billions and billions of dollars and leveraged it up. So it was really, they were willing to pay high yields, and they were passing some of the yields down. And back then, the treasury yield was at the low 50 basis points. It was trading more between 1 to 3%. So there was a huge arbitrage, for even institutional established players, taking TradFi, interest rates really, and deploying the capital in crypto. And I think that was the yield arbitrage that was possible. This cycle right now, of course, we're having the Ethereum staking yield, at 2.85% versus the 10-year treasury yield at 4.1%. So there's, of course, negative carry for anybody in TradFi. And I think that's why, the staking yield right now is not that attractive. And I think when you look at, for example, Coinbase, they only, I think, pay 1.8 or 1.9. So there's even, a lot more cost involved there. So in the end, investors sort of like, are they really going to give up more than 2% to stake in Ethereum that is extremely volatile as collateral versus the TradFi market? Maybe, but maybe not. And maybe that's why we're seeing a lot of unwinding in Ethereum staking, per se. But, as you correctly pointed out, if, for example, BlackRock can push through their ETF staking for Ethereum, and they're currently charging only really 25 basis points, and they were actually charging, I think, only 12 until the summer. until they get a certain AUM really for their, for their Ethereum ETF. So that's, of course, a lot less than what some of the other, the DATs are basically proposing, right? So, of course, it's not really transparent. So we're not really so clear what are the costs are, but a lot of the DATs have, 10-year contracts with the strategic advisor, and the strategic advisor usually gets, 1% of the AUM per year. So that's a cost of, 100 basis points. Then management gets also, paid, for their compensation, basically. And then, of course, there are some other hidden warrants and hidden costs where some optionality, where management can buy out, 5% of the shares, for example, at a really fraction of the price. So that's kind of like all these costs. And I think these costs can easily add up to sort of 1.5 to 2%, depending on, which DAT you look at. And I think that's sort of like a hidden cost that people are not really aware of because they're not really publicized. There are, of course, a lot of SEC filings, but it's very difficult to go through. It's not really clear. We have tried to go through it. But nevertheless, I think when you look that, that you buy a lot of the DATs, initially before at the premium, why should you buy it at the premium when you can just buy it at an NAV of 1 and then probably get your staking yield as well? And I think because BlackRock is, of course, a huge player, they probably get, a fair price really for their, staking yield that they're going to pass on, because they want to be the, one of the low cost ETFs. And I think that's why they were so successful and raised so much capital year to date. So I think there's really this big shift happening. And then one of the key arguments that a lot of the DATs were playing might not actually be valid anymore for next year. So there might be also some story. And I think, if I may add one more point, because it goes, to our Ethereum comment like earlier, so far we have not seen that BlackRock was pushing the Ethereum narrative. Of course, we have seen Larry Fink on TV quite frequently, has slowed down a little bit, but, Bitcoin is digital gold. And there has not really been a narrative around, Ethereum. And we're waiting for, the marketing department of BlackRock to push this story. But once they push this story, we might get a little revival in the DeFi story. And I think that's why there might be a level where we want to buy Ethereum, and we want to be looking out for that. But we need kind of more the macro indicators to turn around first.
Hey, founders and developers. If you're looking to bring on-chain trading to your product, wallet, or platform, check out the new Uniswap Trading API from Uniswap Labs. It's your plug-and-play gateway to global on-chain liquidity. No deep crypto experience required, and no need to manage complex integrations or ongoing maintenance. With the Uniswap Trading API, you'll get enterprise-grade on-chain execution, combining both on-chain and off-chain sources for the most competitive prices. Simply put, more liquidity, less complexity. And this isn't just any API. It connects directly to the Uniswap protocol, which has securely processed over $3.3 trillion in total volume with zero hacks. So stop worrying about liquidity infrastructure and focus on building your product. Get access to the same liquidity that powers billions in swaps through one powerful API. Visit hub.uniswap.org to learn more.
Before we wrap up, I just want to see if you have any final thoughts, and anything that's kind of left on the cutting room floor, any contrarian opinions that you're itching to get off your chest as we move into year end.
Well, I mean, year end is, is almost there. So I think, we're not going to see much. We expect actually the Fed will stay on hold in December. I think that's not the news that we crypto investors want to hear, but, we just have to trade with whatever we get. And then I think, even in January, it's not going to become so clear as well, right? Because, the Fed doesn't have economic data. It doesn't really seem that even like the employment data is as weak, besides some, of course, anecdotal layoffs here and there. But it's going to be actually a very tough narrative unless really the Fed starts to shift a little bit, dovish here. And I don't think that's going to happen. And of course, then we're coming into, next year. And next year is really the fourth year of the Bitcoin cycle. And, we don't think the Bitcoin cycle has much to do really with the halving. But, nevertheless, there is this, fourth year where Bitcoin tends to be weak. And this year was supposed to, of course, be a positive year. So maybe we still finish a little bit marginal in the positive side. But, the human psychology, the human life is really built on, on really these 4 cycles, right? 4 seasons, 4 quarters. I think there's also, spiritually, a lot of the signs. So I think when you look deeper, there's a more meaning in this sort of like 4th year where things need to reset itself. And I think that's why we're a little bit worried. And that's why we think actually next year will also be a tough time. And it might be that, we're seeing, a low earlier in the year and then sort of start to rally because, Fed is going to turn dovish. I think that's, almost like pretty clear. But the question is, are we going to be then at 84,000? Are we going to be then at sort of like 73, 75,000? At that level, it's probably very, interesting levels because, again, if BlackRock files a staking ETF now, that means they got to get ready. They're going to get their marketing and their salespeople ready for next year. They're going to push this product. I think there's no doubt. So as always, there's a lot of stuff happening in crypto. But right now, the macro headwind is, still forcing us to be a little bit on the sidelines. But I think there's still some great opportunities next year.
Great. All right. Well, thanks so much for joining us. We'll have to have you back. Thanks to everybody for watching and listening. And we will be back next week with another episode of Bits and Bips, the interview.